You are welcome to this today's lesson. In today's lesson, we are going to do the indirect transfer pricing. Another new question. Question number 3. Okay, this is question number 3. Here in question number 3, this says um, Kim's Limited is a company which manufactures a single product. Finished goods are transferred from the factory at a production cost plus 15% unsold goods, right? Cost plus 15%. Okay, they are selling cost plus, that means production to trading. They transferred cost plus 15% at the rate of 15%, keeping a 15% margin, right? 15% margin. Okay, and unsold goods are stored in the warehouse, right? Unsold goods are stored in the warehouse. The selected balances extracted from the trial balance for the year ended 31st September 2024 were given as follows. Revenue, we have taken 794 7050, and purchase of raw materials, raw materials 794 750. Revenue, okay, 1,845,000. Carriage inwards 4,250, and factory production wages 382 500, and factory supervisory wages 64,000, and administrative wages 115,000, administrative wages 115,000, and general expenses 78,000, and depreciation 55,000 for plant and machinery, right? And office friction fittings 37,500. The additional information, in the additional information, this is first at September 31st 2024 were accrual general expenses 5,000. General expenses, we have said they have given 78,000. With that, 5,000 is accrued expenses, right? With that, 5,000 is accrued general expenses, right? And there were accrued general expenses 5,000 and prepaid general expenses 3,000, and prepaid 3,000. General expenses itself, right? And if you open up a general expenses account, right? You can open up a general expenses account, right? General expenses. Prepaid is deducted. Okay, prepaid is deducted. Okay, and general expenses. General expenses. Okay, expenses given, paid is 78,000. Paid 78. Paid. Okay, paid. This is 78,000. Out of 78,000, still we had to pay. Have to accrued. 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 Accrued means have to pay. To pay. How much? 5,000. 5,000. Then how much it comes? 83,000. Out of 83,000 prepaid, paid 3,000. 3,000 you had to deduct. Okay. Then balance is 80,000. Chargeable for the year. Chargeable for the year. Right? Chargeable for the year 80,000. Okay. Then if you go to the second adjustment details of and the general expense. Out of general expenses, 65% is for the factory, right? For the factory, this is factory and office, right? Office, right? If it is, this is factory, this is for the office. They say 70% of the 65% of the general expenses is for factory. Then 35, remaining 35 is for the office, right? Okay. Then if that is the case, out of 65, 80,000, okay, out of, wait, with a 80,000, 80,000 into 65%, that means 52,000. 52,000 means you say 81 to 3 into 0.65. 52,000. Okay. 52,000 is for the factory and 28,000 remaining balance is for the office. Okay. So we had to put here for the factory general expenses. Expenses 52,000. Right. Here general expenses is 28,000. Right. 28,000. Okay. Then if we go to the second adjustment, details of inventories are as follows. Raw materials opening stock 110,000, right? It is the 110,000 opening stocks 110,000, right? And work in progress 17,500. Work in progress is 17,500. Okay, 17,500. Finished goods at transfer price 19,500. Finished goods revenue, right? Revenue, we had to say here revenue, revenue, okay, revenue, okay, and cost of sales, cost of sales, opening stock, right? Goods completed less closing stock, right? This is the gross profit. Okay, gross profit, right? If we say otherwise, administration expenses, administrative wages, general expenses, and depreciation for office furniture, office fixture and fittings. Okay, this is 115,000, this is 28,000, this is 37,500. Okay, so now what I going to do is I have to raise this one. Okay, we raise this, then we can write it clearly. Okay, right here, revenue, this is new revenue, right? Cost of sales, opening opening stock, finished goods, add goods transferred from factory, right? And less closing stock of finished goods, right? Then you will arrive at a gross profit, right? Here this is opening stock is how much? Opening stock is 19,550. 19,550. Okay, and finished goods transfer price is 19,550. Now raw materials, closing stocks 125,000. Raw materials closing stock, raw material closing stock 125,000, right? 125,000. Work in progress closing 14,000. 14,000, right? And finished good transfer price 21,505. 21,000, 21,505, right? That is the given, the adjustments given, right? So this is manufacturer account and income statement account for the business. So shall we do the addition part, right? Addition part 1 and 5, 9,000, 189, 1,000,000, 110,000, right? 110,000, right? 909,000, right? 1989, 909,000. 909,000 minus 25, 4,008, 4, 8 minus 1, so 784,000, right? Direct wages, add, then you will arrive at the prime cost, right? If you add the 9, right? If you add this one, 500 and 6, 16, 1, 8, 1,166,500, right? Factory overheads, you had to add it and see how much. 6, 6, 1, 55,000. Depreciation, how much? 55,000. 55,000, right? And 6, 12, 12 plus 5, 12 plus 5, 12, 171,000, right? 500, 7, 13 and 1, 2, 3, 1,337,000, right? From with that you had to add the opening stock. 0, 0, 1, 8, 15, 1, 3, 4, 5, 1,355,500, right? From that 14,000 you had to deduct it, right? 1, 4, 1,341,000, 1,341,000. Cost is 1,000,000, 1,341,000, right? 1,341,000 into 0.15. It is 201,150. 201,150. Right? Right? This is detail of working orders. Finished goods at transfer price. Finished goods at transfer price. 201,550. Then total cost is 150 and 2, 4, 5. 1,542,000 is the goods transfer, right? 1,542,150, right? From that, if you add this one, 0, 0, 6, 7, 9 and 3, 1, 2, 2, 2, 2, 2, 2, 2, 2, 2, 2, 2. 1,842,000, right? 42,000. 2 and 9, 1, 2, 6, 61. 1,561. 1,561. Right? 1,561. 1,561,000 minus 21,505. That is 1,539. 1,539,495. 495. Right? Then what is the gross profit? Gross profit is 1,845,000 minus 305,000. 305 305,505 gross profit. Right. Gross profit. Here they said the finished goods opening and closing are at finished goods. Right. Finished goods closing calculation. Finished goods closing. Right. This is how much closing stock, closing value U is equal to 21,505. This is equal to 150. Then margin equal to 21,505 divided by 115 into 115. Right? 21,000 21,505 divided by 100 into 50. It is equal to 3,220. 3,225. 3,225. Right? Opening value is 19,550. It is equal to 115. Right? Then 19,550 divided by 115 into 15%. That is equal to 19,550 divided by 115 into 15. That is 2,550. 2,550. Right? 21,505. 21,505. 21,505 divided by 115. 2,805. This is 2,805. 2,805. And then if you open a T account, right, what you called unrealized profit, and you have to open a unrealized profit account, right? You have to open unrealized profit, unrealized profit. That means opening value brought forward will be 2,550. 2,550. Carried forward value, carried down value, how much? 2,805. 2,805. Close the accounts. Brought forward should be next year 2,805. They take the greater value 2,805, 2,805. What is the difference? 255 is the difference. This should go to the PNL. PNL. Right? It should be PNL should be debited. Right? PNL should be credited. Right? Because PNL should be credited. In the unrealized profit brought forward is 2,550. Right? Then we have to increase the value to by 255. Right? 255 revenue 1 million. Okay, sorry. Here there's a gross profit. From the gross profit you have to reduce the deduct the unrealized profit less unrealized profits. That is equal to how much? 255. 255. 255. If you deduct the 255 from the 505, 250, 305,250. Right? Now the expenses, admin expenses are 500, right? 15, 20,000 to 5, 7, 8. 180,000 is the expenses. 180,000. This has to be deducted, right? 180,500. Then here you will get 750 for 124,750 is the net profit, net operating profit, net operating profits, right? Net operating profits. Have you understood this portion? This is the unrealized profit calculation method, right? This is the unrealized profits calculation. Calculation of unrealized profit. Okay, calculation of unrealized profit. Calculation of unrealized profit. Unrealized profits. Okay, this is the calculation of unrealized profits. Unrealized profits. This is the way of calculation. These are the workings. These are the workings. Okay, understood? Have you understood this question? And they wanted to say, they said in C part, explain why business might create a provision for unrealized profits, right? That is different. And additional information, one more information they says, budgeted closing inventory value of finished goods at transfer price at 31st October 2015 was 18,400. If it is 18,400, we have to work it out. That's all, right? That is the only difference they gave. So, but what they wanted you to do is, they are checking your ability, or checking you whether you know to calculate the unrealized profits, right? Unrealized profits in the market, markups, right? So again, they says D part, analyze the effect. Look at, analyze the effect on the budgeted profit for the month of October 2024. Budgeted value, right? The price at which product could be bought from an outside supply is expected to increase. It is now proposed to transfer the finished goods at, right? They says in the October, this is September, no, as at September, right? As at September 2024. Now they says in October, this is September, this is September, right? Now it is October. October, they says in the October, the budgeted closing inventory value of finished goods transfer price was 18,400. Right? Analyze the effect on the budgeted profit for the month of October 2015 due to the changes in the provision for unrealized profit. Provision for unrealized profit. Right? They says in the closing stocks will be 18,505, right? If it is the October, right, closing stocks, right, closing stocks, unrealized profit calculation, okay, in the October. Closing stocks, closing stocks would be how much? 18,400. 18,400. If the 18,400, then margin would be 18,400 is the 115, then 15%. How much? The 15%, right? 18,400 divided by 115 into 115, right? Equal to 2,400. The unrealized profit portion is 2,400, right? This is for the October, right? The then September unrealized profit. September unrealized profits was 2,805. 2,805 rupees. Now in September, October, how much unrealized profit was? 2,400, right? Then 405 should be transferred to the profit and loss account, right? October, they haven't say whether about the other budgets, right? Closing stocks, right? Opening stocks, how much, right? They said the budgeted closing inventory value of finished goods at transfer price at 31st October 2015 was 18,500, right? Analyze the effect of the budgeted profit for the month of 2015 due to the changes in the provision for unrealized profit. What is the effect? Opening opening value would be opening value would be how much we have to. I will raise this one, or I can put it here, right? Right here, if you say unrealized profit, October, right? October unrealized profit, unrealized profits, right? Profits brought forward would be the closing after. Brought forward would be the closing stocks of previous year, 2,805 September 1, right? October, sorry, brought forward would be 2,805, right? Carried down would be 2,400, right? Carried down would be 2,400. Then what is the, which is the greater one? 2,805 is the greater one. So 2,805 you are taking. P&L you have to charge 405. 405 you have to, the realized profits, right, is a September is opening, realized profit is, right, this is September. October 1st opening balance is 2,805 unrealized profit. You have to reduce the unrealized profit, right? You have to add it, credit to the P&L, right? So answer is the profits for for October, for October will increase by 405 rupees, right? 405. This is the 405. Profits will increase in the October, right? That is the answer for D part. And E part required advise the directors of the, that is okay, that is finished, right? The additional information, the price at which the product could be bought from an outside supplier is expected to increase. It is now proposed to transfer the finished goods at cost plus 20%. The advise directors whether or not the markup should be increased. Justify the answer. Right? The cost of production, cost of purchases. Now they says D part, cost of purchases is increased by the supplier. Then they wanted to advise us whether to increase the markup, right? If the purchases cost is increasing, the markup is nothing to do with the purchases, right? Purchases, when the you had to say increase in the purchases will not affect your margin, right? Will not affect your margin. We don't need to increase our margin to 20%, from 15% to 20%. They wanted to, the management is advising to directors, now production to trading, transfer the price at 20%, right? Because there is an increase in the purchase cost. But you have to advise as an accountant whether to increase the margin percentage or not. As an accountant or management accountant or financial accountant, you have to say the increase in the production cost is nothing to do with the production margin, right? Nothing to do with the margin. So you say keep the margin as it is, right? Product price will automatically increases, right? Product price, the cost of production automatically will increase by the percentage of increase in the purchaser's cost, right? So there is no need for us to make an increase in the margin. Okay, that's all. That is the question. Okay, I hope to meet you in next lesson with the new exercise. Okay, thank you.